For supercharged dividend stocks to buy if there's a stock market sell-off. The U.S. stock market is currently at all-time highs, which has been a joy for investors. But nothing lasts forever, and sell-offs are a normal part of long-term investing. Instead of panicking, treat sell-offs like an opportunity to buy great companies at lower prices. Buying dividend stocks at lower prices means starting with higher yields and generating more passive income with your money. Here are 4 fabulous dividend energy stocks as prime buys that can put lots of cash in your pocket. When prices fall, buy these 4 energy stocks. You'll have North America's energy infrastructure covered. 1. Nextera Energy. Fossil fuels aren't going away anytime soon, but renewable energy has steadily contributed more to America's electric grid. Nextera Energy, NYSE, is one of the world's largest green energy producers and the largest electric utility business in the United States. Growth in renewable energy has fostered big investment returns. Since going public, Nextera has beaten the S&P 500. The company is also an excellent dividend growth stock. The payout has increased for 30 years, and investors get a solid 3.7% starting yield. The best part? It's dividend growth. Management has raised the dividend by an average of 11% annually over the past 5 years and is guiding for 10% increases through at least this year. That makes Nextera a dividend growth stock you want to snap up whenever the price dips. 2. Exxon Mobile. Energy giant Exxon Mobile, NYSE, XOM, explores for, refines, and sells energy products worldwide. The company's premier assets in the Permian Basin and Guyana will serve as ExxonMobil's foundation for fossil fuel production. Additionally, ExxonMobil has invested in other areas, including carbon capture and lithium mining, to diversify itself. Financially, ExxonMobil is rock solid with just $6 billion in net, total minus cash, long-term debt. The company has paid and raised its dividend for 42 consecutive years, enduring the industry's down cycles, recessions, and a pandemic. Investors can confidently grab the stock and enjoy its starting 3.5% yield. Management is repurchasing $40 billion of shares over the next 2 years, a sign of confidence in the business. 3. Enbridge. Oil and gas must move from where they are extracted to refineries and exports. This doesn't happen by itself. Midstream companies like Enbridge, NYSE, ENB own vast networks of pipelines and storage to make this possible. Enbridge is one of North America's largest energy companies. Its network of pipelines spans thousands of miles from Canada to the Gulf of Mexico. It also operates renewable energy projects and a natural gas utility business. Enbridge acts like a toll booth, making money on fees when oil and gas flow through its lines. That makes the business less volatile, and the utility business also helps create dependable revenue streams. Enbridge has raised its dividend for 28 consecutive years, a testament to its business model. Additionally, investors get a high starting yield of 7.4%. The payout ratio is manageable at 81%, so investors can feel reasonably confident in it despite its abnormally high yield. 4. Kinder Morgan. A peer of Enbridge's, Kinder Morgan, NYSE, KMI, is a pipeline company that transports natural gas, oil, and other materials through a network that spans over 80,000 miles and covers most of the United States. Natural gas is Kinder Morgan's primary business. It moves an estimated 40% of America's natural gas production flowing through its system at some point, which makes it a crucial component of U.S. energy. The company has paid and raised its dividend for the past 7 years. Today, the dividend payout ratio is healthy at 61% of Kinder Morgan's cash flow. Additionally, management believes that U.S. demand for natural gas will grow by 19% by 2030, and liquefied natural gas and Mexican exports, where Kinder Morgan's lines run, will nearly double from current levels. That creates a backdrop for potential growth over the coming years, making Kinder Morgan a dividend stock worth scooping up at its hefty starting yield of 6.3%. Should you invest $1,000 in Nextera Energy right now? Before you buy stock in Nextera Energy, consider this. The Motley Fool Stock Advisor analyst team just identified what they believe are the 10 best stocks for investors to buy now, and Nextera Energy wasn't one of them. The 10 stocks that made the cut could produce monster returns in the coming years. Stock Advisor provides investors with an easy-to-follow blueprint for success, including guidance on building a portfolio, regular updates from analysts, and 2 new stock picks each month. The Stock Advisor service has more than tripled the return of S&P 500 since 2002.